We're going to, again, dig into some numbers, and we're going to look at the true costs of term insurance this time. And if you've been taught to buy term and invest the difference, stay tuned, because I think you'll be surprised by what we show you in this particular episode. All right, so let's kick this off by going back and reviewing asset classes, right? So we've talked about this before, and there are different types of assets out there, different classes of assets. You've got stocks, bonds, treasuries, real estate, cryptocurrency, your business. These are all different asset classes. Life insurance, specifically whole life insurance, which is a permanent life insurance, is just another asset class. There's a lot of strong opinions out there about whole life insurance versus term, which is what we're talking about today. But if you really boil it down, whole life insurance is just another asset class, and it has its place in your financial life just like any of those other asset classes do. So something interesting that I see out there is people are very adamant about paying a lower price for their life insurance. So they talk about buying cheap term insurance to cover the life insurance side of it. Yet if you ask those same people whether they'd rather pay a lower amount for where they live by renting or a higher amount for where they live by making a mortgage payment and buying a house, most of those same people would say they'd rather pay the higher amount to buy the house where they live. And the reason for this is pretty simple. It's because they know they're buying an asset, and every time they make a mortgage payment, it builds equity in their house, in the asset. And so what's crazy is this conversation is actually the exact same conversation when it comes to buying term insurance or buying whole life insurance. And when you buy term insurance, it's just like renting an apartment or renting a house. Every time you make your rent payment, you make that every month. And then when you move out of the apartment, you don't get any of the rent money back. It's the same thing with term insurance. You make your term premiums. And when the term is done, the policy is done and you don't get any of that money back. Whole life, on the other hand, is much more like buying a house, where every time you make a mortgage payment, you build equity in the house. With whole life insurance, every time you make a premium payment, you build equity in the policy. That equity is just called the cash value. And so when you look at it like that, the term versus whole life, a lot of the objections that people have towards it, they stop making as much sense. If we're in the market to buy life insurance, do we want to have it as a liability or do we want to have it as an asset? It's really very simple. What makes term insurance a liability is, statistically speaking, it's something like 1% of term insurance death benefits actually pay out. With term insurance, you have the life insurance protection during a time when you're statistically very unlikely to need it. Then at the end of the term, you no longer have the life insurance protection during a time when you're guaranteed to need it. So it's a little bit backwards in terms of having only term insurance to protect your life. But that's why the premium price is so much lower, because the insurance company understands this, and that's how they're able to price it that way. The risk to them is very much lower during that term, during the age when you qualify for term insurance. So just understanding that helps us get our head around comparing these two types of life insurance. Now, knowing this, we can't just compare the premium price on its face, right? We can't use grade school math and just add up the premiums and compare these two life insurance products, because it really just doesn't tell us the full story, right? Whole life insurance is an asset. Term insurance is most likely a liability. When we compare these two things, we actually have to use financial math. And when we use financial math, we have to include the variable of time, and then we also include a cost of money aspect to it. And so if we look at term insurance, let's use a $1 million level term insurance policy that's a 30-year term. The way we can't just add up the premiums over 30 years and come to the cost. We actually have to assign a cost of money. So let's say the cost of money is 4%. So we're giving up 4% every year on top of the premiums that we're paying over 30 years. That's actually the correct way to calculate the cost, not the price of the term insurance. The price is your premium. And in this example, I'm going to go over, it's $1,100 a year. That's the price. but the true cost of that depends on how many years you calculate it. And then we have to take into an account that time and then take into account the cost of money, which in this example is going to be 4%. That's called the net compound cost. And that's really how we're going to analyze those two. So you can take the net compound cost of term premiums, assuming the death benefit does not pay out, and you can compare that to whole life insurance and the net compound cost of those premiums, knowing that anytime you want to stop the whole life insurance policy, you get the cash surrender value back, or you know that the death benefit is guaranteed to pay out when you die, not if you die. So there's a future cash flow involved there. So even though the premium price is higher, the net compound cost is much lower because you're building something all along the way. What I'm going to do now is I'm going to switch over to a couple slides, and I just want to graphically try to illustrate this for you guys. So let me switch over to my slides here. Okay, I've got my slides pulled up. I've got my laser pointer turned on so you can see where I'm pointing at. And again, what we're looking at here is the net compound cost over 2 to 3 generations, looking at a $1 million 30-year level term policy. And during that 30-year term, this is going to be $1,110 per year for the $1 million death benefit coverage. So what we're looking at here, this person buys the policy when they're 40 years old. And so in 30 years, they're going to be 70 and they're going to retire. And so the common way of thinking about insurance is that once you're retired, you don't need the insurance anymore because you're done working. You don't need to protect your income. Totally separate discussion, but I think I'm going to show why that's false on its face if you care about generational wealth or passing on a legacy, but it's also false in terms of what it can do for you in your retirement, where it becomes asset protection. But I don't want to go too far down that rabbit hole. We're just looking at the net compound cost of term insurance right now. So here we are, age 70, 30 years later, the $1 million term insurance policy drops off, it expires, and we can now see that the net compound cost of that term insurance was $62,000, assuming a 4% annual cost of money. And so what we did is we gave up $62,000 with those term insurance premiums over that 30 years. That's what we gave up. And now here we are at 70 years old, and we have nothing to show for that $62,000 because this is term insurance and the term policy expired. Now, what I do want to point out, and this is a little bit of another aside, is you actually could keep this insurance policy. And this may not be true for every term insurance policy out there, but for the one I'm looking at, you actually do have a contractual right to keep this policy. But what happens is the premiums go way up from here. So they paid $1,100 a year for the 30 years of the term. And if they wanted to keep this for another year, the premium would go from $1,100 to $61,000. So that's 60 times what they were paying for the previous 30 years. In fact, this person can keep this policy for up to age 95. And that's in year 55, the premium would be $883,000 in order to keep it. And of course, so it just keeps going up and up every year. So it goes from 61,000 at age 70 all the way up to 883,000 at age 95. I just wanted to point that out because it actually helps us understand why the term premium price is so low, because they've really just carved out a chunk of the actuarial curve and created this level product. But if they wanted to keep this for longer, they would need to catch up with their actuarial costs, or else the insurance company can't take on the risk to do that. Okay, so they retire at age 70. They stop paying premiums, but they're still going to live for a while. So let's just take a look at the net compound cost over their life expectancy, and we'll just use age 85. At age 85, the net compound cost of this term insurance, this costs them $112,000 by the time they get to age 85. That's what they gave up for paying for this policy. So this isn't obviously a massive amount of money, but it's quite a bit of money when you compare it to the term price, where people are not really thinking about that low monthly price actually has a significant real net compound cost over a period of time. And if we take a look at what this cost the estate, so this is $112,000 that did not get passed along to the next generation. And so the 112 doesn't seem like that big of a deal over an 85-year lifespan. But if we look at what that would have cost the next generation by not making it over to the estate, and let's say this person lives another 50 years, this person's son or daughter lives another 50 years, at the end of this person's lifespan, that's $800,000, right? And so that starts to look like some real money, 800,000. Now that's over basically 95 years. And so that could still not look like the biggest deal, which maybe it's not, but that's $800,000. But this is just the cost of the premiums of one 30-year term insurance policy. Right? This is just the lost opportunity cost of what those dollars could have done if they had gone to some other 4% investment rather than buying the term life insurance. What, though, did we give up by not receiving the $1 million death benefit? Because that $1 million dropped off, what did we give up by not getting that? That's what I want to show you next. And this starts to look very significant. We're up here in the orange. These are the net compound cost of the term premium. But look at the net compound cost of that $1 million that this person's son or daughter did not receive. Over the course of the generation two's lifespan, if they live to age 85 as well, this was $6 million. That's starting to become real money. $6 million, just assuming a 4% cost of money, $6 million bucks. But what if we took this out just one more generation and looked at the grandchild? What would happen if we looked at what they lose out on over the lifespan of the grandchild as well? And now we're looking at this. Here's the original slide and what we originally missed out on with the $1 million in red. And now this is what it could have grown to in purple. And so we go out 2 generations, and that's $43 million at a 4% clip that this family could have had in their life if they had just respected the fact that $1 million, what that could have done for their family. And this is the kind of thing that I really want to hit home with people. People look at the price of whole life insurance. This absolutely is something that could stay in that family, in that estate, if they had a permanent death benefit. This never goes anywhere if you have a permanent life insurance death benefit. You're never giving this up. And in fact, this would be much greater if they had a $1 million whole life insurance policy, because the way that we structure whole life insurance, this death benefit would probably grow to something more like $3 to $5 million for each generation. And so if you start adding on the 4% onto those numbers, it just starts to dwarf anything that could happen with this lost term insurance death benefit. So this is really what I wanted to point out. This is the true cost of term insurance, because again, statistically speaking, it's highly unlikely that it'll pay out. But statistically speaking, it's guaranteed that you're going to die at some point. And so why on earth would we not want to have a guaranteed outcome paired with the guaranteed event of us eventually dying, which we all have to do? So, if you have any questions on how I came to these numbers, get in touch with us and we can start to talk about how we can make these strategies not only create massive wealth 2 generations down the road, but also create very good wealth for you while you're still alive, using the strategies that can be paired along with whole life insurance, the infinite banking concept, of course, being the number one. All right, everyone. Thanks for tuning in and looking forward to seeing you on the next one.